Can you see the Excel sheet?
Yes, sir.
Yes, sir.
Okay, so just open your Excel sheet also. You can also, look at the Excel sheet while we solve it. Okay, so Kajal, can you read this?
Yes, sir. Mr. K purchases a house property on April 10, 1992 for rupees 65,000. The fair market value of the house property on April 1, 2001 was 2,70,000 and stamp duty value was 2,20,000. In May 2008, Mr. K constructed the first floor by incurring a cost of rupees 2,35,000. Subsequently, in January 2009, Mr. K gifted the house to his brother, Mr. D. On February 10, 2024, Mr. D sold the house for rupees 12 lakh. CII for financial year 2001 and 2 is 100, 4 and 5 is 113, 8 and 9 is 137, and 2023 and 24 is 348. Compute the capital gains in the hands of Mr. D for assessment year 2023-24.
Okay. So this is the question. So he has sold the house on February 10th February to his brother on 10th. So actually this slight change. Okay, so this should be 24-25 assessment year.
25.
Okay, so this have not changed. Okay, so you can change in your Excel sheet also, because he has sold the house on February 10, 2024. So which is the 23-24 with the last financial year, and the assessment year will be the year which is complete going on now, 24-25. Okay. Now Mr. K has purchased the house property on April 10th, 1992. So it was way before April 1, 2001 when the CII index started in India. Okay. So any property which is purchased before 2001 1st April, then we have to look at the fair market value of the house. So this price is 65,000, whereas the fair market value was 2,70,000, and the stamp duty value was 2,20,000. Okay, so we have to just look at this. So we have to choose between these three values, and we find that it should not be greater than the stamp value. So of course he can't take 65,000, because then he has to pay more tax, because the fair market value is 2,70,000. Whereas the stamp value is 220, then he has to take a lower value, that is the stamp duty value. So because if he takes a stamp value, then it will be beneficial for the income tax people, because if he takes 270, then CII will make a lower tax for when we apply the index, then the index property will be more. Okay, so that's why so we have to adopt the stamp duty value, because the law says that it is a stamp duty value which has to be taken. So if we can just read through this, so you'll understand that. So last time also we have done that. Okay, just Kajal, can you read this?
Yes, sir. Cost of acquisition of certain assets at a glance. Where such capital asset became the property of the assessee before 1st April 2001, cost of the asset to the assessee of fair market value as on 1st April 2001 at the option of the assessee.
Okay, so
However, in
that means,
case
sorry Kajal, just hold on. So he has to take either the price at which he has bought or the fair market value. So it is an option given to the assessee. So whether if the the purchase price was higher, then he can take the purchase price, but definitely the fair market value will be always higher. Okay, read further.
However, in case of capital asset being land or building, fair market value as on 1st April 2001 shall not exceed stamp duty value as on 1st April 2001.
So that means, there will be three values. One will be the price at which, this guy purchased the house or the land or building, or the fair market value. If the property was purchased before 1st of April 2001, then he has to, find out what was the fair market value on 1st April 2001. So for that, he has to go to the registered valuer, and he is going to value the property. Of course, he has to pay certain fee, and he will get a value from the registered valuer. Now, the law says that if the fair market value is greater than the stamp duty value, then we have to adopt the stamp duty value for the purpose of indexation. Okay, fine. So if we just go back to the question here, so which means that the for indexation purpose we have to take 2,20,000. Okay. Now in May 2008, Mr. K constructed the first floor. Okay, for by incurring a cost of 2,35,000. So there is a cost of improvement also. Okay, which happened in May 2008. So that means it has to be 2008, 2009. We have to look the index because this will fall in 2008 and 2009. Okay, so for the improvement purposes, we have to take this value, which is 137, and then we come to Mr. K constructed the first floor on for this thing. Okay. Subsequently, in January 2009, the K gifted the house to his brother. So he gifted the house in January 2009. So that means again it is 2008, 2009 when he gifted the property. Okay. So because the property has been gifted, so the indexation benefit will be applied from 2008, 2009 because Mr. D has now become the new owner after the property was gifted by Mr. K to Mr. D in 2009. So for the purpose of applying the CII year, we have to take 2008, 2009 when the property was gifted to his brother. So, and this property was sold by Mr. D for 12 lakhs. So let's go and solve this problem. So the sale consideration is 12 lakhs, okay, because this property was sold for 12 lakhs. So, but before that, we have to see that there is a computation of taxable gains of Mr. D for assessment year 2024-25. Okay, fine. So that is what we changed there because it was mentioned as 23-24. Okay, so here it is okay. So computation of taxable capital gains of Mr. D for assessment year 2024. Now the sale consideration. So Mr. D has sold this property for how much? 12 lakhs. So that is given in the question. Then index cost of acquisition. Now we have taken this as a stamp duty value. So if you look at this, so there were three values: 65,000, 2,70,000, and 220. So here, as per the law, the value taken for the purpose of indexation has to be 2,20,000. This will become the cost of acquisition. Okay. So this will be the cost of acquisition in the hands of Mr. D, fine, because he is the previous owner. Okay, the cost to the previous owner will become the cost to the new owner. Okay, so 2,20,000. So here we have applied the cost of index cost of acquisition. So which will be basically this and this. Okay. So if you look at the formula here. So this is 2,20,000 multiplied by 348 divided by 137. So we get the index cost of acquisition as 5,54,000. Okay. So similarly, for in the same year, the cost of improvement has also happened. Okay, there's an improvement also. Mr. K constructed the first floor in May 2008. Okay, Mr. K constructed. His brother, who had gifted, he constructed the first floor by incurring a cost of 2,35,000. Okay, so this was also in May 2008, which means it will be 2008, 2009. Okay, May onwards, so 2008. So the cost for the improvement also will apply the 137. Okay, so it was gifted in January 2000, the same financial year it was gifted. Okay, so the financial year remains the same for the purpose of counting for the first floor, okay, as well as the whole house was gifted to him on the same financial year. So that's where we have used the indexation cost of acquisition here. Then here index cost of improvement here also we have applied 2008, 2009, and 2034, 23, 24. So here also.
Sir, the cost that we have taken is 2,20,000, which is the lowest of fair market.
The cost to the previous owner, okay, but of course based on the formula that it has to be restricted to stamp duty value.
Yeah, so we have taken 2,20,000 because that is lower stamp duty.
Yeah.
So while indexing this, shouldn't we take the 2001, 2000 and 2001? Why we are taking CII of 2008 and 9, sir?
For indexation purposes, okay. So the law says, the departmental view is that when the year in which the property was gifted, okay, that year needs to be counted. But of course, we can take the view of the judgment here. Just read this, Kishore.
As per the view expressed by Bombay High Court in CIT versus Manjura J. Shah, in case the cost of acquisition of the capital assets in the hands of the assessee is taken to be cost of such assets in the hands of the previous owner, the indexation benefit would be available from the year in which the capital asset is acquired by the previous owner. If this view is considered, the indexed cost of acquisition would have to be calculated by taking CII of 2001 too, since the fair market value as on 1st April 2001 has been taken as a cost of acquisition.
So this is what you said actually. Can we take, the CIA based on 2001, 2002? I mean, can we apply
Hmm.
the index based on 2001, 2002? Of course, the departmental view is that you should take, for the indexation purposes, you have to take the year in which you became the owner, not the previous owner, because now
So
you have become the owner.
department is trying to maximize their gain.
Huh. And whereas, we are trying to see that if there is a judgment in our favor, can we, take that benefit? Of course, I told you last time, because this has been decided by the Bombay High Court and not by the Supreme Court of the India. So this is applicable, of course, to all. Of course, more, the Department of Maharashtra, the taxation department will be, they will have to abide by the Bombay High Court, because this case has not been challenged by the Maharashtra taxation department after the Bombay High Court decided, and it decided, I think, long back. Okay, so the taxation authorities in Maharashtra will have no problem to accept it. But in case of, suppose you are filing the case in Delhi, and you have this cases for a property of any place other than Maharashtra, then if you take this view and file your return, of course they can issue a demand, and you have to go for a case against them, and then the matter will be decided again in the High Court of Delhi or any tribunal. Fine, but you can always take this view also, even if you are in anywhere, any part of the country, unless it is not challenged by the department. Okay, so sometimes the department can will not raise anything on you. Okay, so or maybe you can just get away by filing a return, because there's only 1%, 2% chance that your case will come under scrutiny. Okay, because all the cases are not done. They are, as it is, they are filed, they are being accepted by the income tax department, except they pick up some percentage of cases, which are called scrutiny cases, where they go and find out whether you have done as per the law or not. So in that case, the chances are that you may face a demand from the tax authorities. But since there is a case which is supporting your your treatment, so you can always go and file an appeal against that case. Okay, fine. Is that clear?
Yes, sir.
Okay, so just read this also, Kajal.
Yes, sir.
Yeah.
Note, for the purpose of capital gains, holding period is considered from the date on which the house was purchased by Mr. K till the date of sale. However, indexation of cost of acquisition is considered from the date on which the house was gifted by Mr. K to Mr. D till the date of sale, that is from January 2009, previous year 2008-9 to February 2024, previous year 2023-24. Since house property was acquired before 1st April 2001, higher of fair market value on 1st April 2001 or actual cost of acquisition can be considered as cost of acquisition. However, fair market value cannot exceed stamp duty value on 1st April 2001.
Okay, now this we have already explained. The only thing is that we have to take the stamp duty value, because the stamp duty value is lower. Okay, so if suppose we have taken, suppose if you would have taken the value, of for example, what was the value? 2,70,000. Okay, suppose we would have taken this value. So suppose the stamp duty was, was also, was not there. Okay. So in that case, there was no capital gain because, the 12 lakh was the sale consideration and index cost of improvement acquisition was higher than the sale consideration. So there was no capital gain. But since we took the stamp duty value, so that led to a capital gain for the assessee and he has to pay 20% tax on that. Okay. So the department would always like that assessees should pay tax and they should not, they should always take the stamp duty value because if it is lower, so it is benefit for the department because they may make a case of taxation for the assessee. Okay. So the assessee has to pay some tax. Is that okay? Is this clear?
Yes, sir.
Now, question number 3. So, Dia, are you there?
Yes, sir.
Okay, Dia, can you read?
Yes, sir. Following are the details provided by Mr. Singh, the SSC for the financial year ended 31st March 2024. The SSC furnished following information regarding sale of property at Chennai. Mr. Singh's father acquired a residential house in April 2006 for rupees 1,25,000 and thereafter gifted this property to the SSC, Mr. Singh, on 1st of March 2007. The property so gifted was sold by Mr. Singh on 10th of June 2023. The consideration received was 25 lakhs. Stamp duty charges paid by the purchaser at the time of registration at rate 13% as per statutory guidelines was rupees 3,90,000. Compute Mr. Singh's capital gain for assessment year 23 to 24. Cost inflation index for financial year 2006 to 2007 122. Financial year 23-24 348.
Okay, fine. So, now there is a case of stamp duty here. So, first of all, I think we should, consider, read something more about it before we solve this question. Okay. Okay. So, Dia, can you read this right from the top?
Sure, sir. Taxability where stamp duty value higher than sale consideration.
Okay, hold on. Hold on. Now suppose you, you have purchased something, okay? So, or you have sold some asset to someone and you find that stamp duty value is higher, okay? Because the circle rate is higher and the sale value is lower, okay? Because, everybody would like to, pay, lower capital gains tax, because normally whenever, a transaction is happening in real estate market, sale or purchase, so there is some kind of a cash, also which is involved. So if you pay, more value in, check, you have to pay more tax, okay? Because that will be considered for your capital gains tax. So, so to, curb all those kinds of things, so this is there. So just read this now, then I'll, I think, okay.
When an assessee receives or claims to receive a sale consideration on sale of land or building or both, and such sale consideration is less than the value.
Yeah.
Yeah, then the value adopted, stamp duty value, circle rate, ready reckoner rate by the stamp valuation authority.
Okay. So, when an assessee receives or claims to receive a sale consideration on sale of land or building or both, and such sale consideration is less than the value adopted by the stamp duty or the stamp duty value or the circle rate. So, for every place in India, there are circle rates which have been, published. So, whenever you buy or sell property, you have to look at the circle rates. Okay. So, normally, your, price should be around the circle rate. Of course, you can always buy or sell at any price, because if the circle rates are higher, then of course you will be paying, you will be selling your property at a lower value. But it may also happen the circle rates are lower and you're, selling at a higher value. So circle rates are just, fixed over the period of time, and sometimes it is fixed in a in an interval of 5 to 6 years. So rates of the properties may either go up and down, and circle rates are the average rates. Okay. Now, sometimes the property can be even lower than the circle rate value because it is not at an appropriate place. It is not in a good place in the same locality. It is, sometimes it's a very good a place. It's, I mean, from the Vastu, or it is north facing. So the value of the property may be much higher than the circle rate. Sometimes the value of the property may be even lower than the circle rate. So it can happen that way. Okay. So the circle rates are fixed, which are average rates for that entire locality. Okay, read further.
If the sale consideration declared by the assessee seller is less than the stamp duty value, then the stamp duty value shall become deemed sale consideration for the purpose of calculating capital gain tax.
Okay, so which means if the sale consideration is less than the stamp duty value, okay, that means if you have sold the property below the stamp duty value, then the stamp duty value shall become the deemed sale consideration for paying the taxes. Okay, suppose in order to avoid tax, you have sold at a lower value. Okay, so the tax authority says in that case you have to pay the capital gains at the stamp duty value and not at the actual value of the transaction on which the transaction has happened. Okay, just read further.
Taxable if the stamp duty value does not exceed 110% of the sale consideration, then such sale considerations shall be the sale value for computing capital gain tax for the sale transactions 1st April 2021.
Now, since, because of this provision, there were a lot of, cases where because, the property can be even lower than the stamp duty because it is not, at a locality which is not, at a place which is not favorable for the person to buy because it is, facing a hospital, or it is facing a school or a temple, or it is not, Vastu perfect property. So, because of that, so there was a lot of debate whether we should take the stamp duty value for paying the taxes. So the law was changed in from 1st April 2021. If it says if the stamp value does not exceed 110% the sale value, then the sale value consideration should be the sale value for computing the capital gains. So if the stamp duty value does not exceed, so let's do a question and here. So look at this. If stamp duty value, suppose the stamp duty value is 1 lakh, it is how much? 1 lakh 9,000. Okay, stamp duty value is 1 lakh 9,000, and the actual consideration is 1 lakh. Then the value for taken for the purpose of calculating the capital gains will be 1 lakh because the stamp duty value is less than 10%. Whereas the stamp duty value is 1,17,000, the consideration is 1 lakh, then we will adopt the stamp duty value for paying taxes. Now, in case if it is 1,10,000 property C stamp duty value and consideration is 1 lakh, then also we'll take 1 lakh because it is exactly at 10%. It should exceed 10%. Then only the capital gains have to be paid at 1 lakh and not paid at 1,10,000. Suppose it is 1,10,500. In that case, the capital gains will be paid at 1,10,000. So because the value may differ, so that's why this benefit was given to the assessees that if the stamp value exceeds 110% of the actual consideration, then only it will be treated for the purpose of paying taxes, the stamp value. Otherwise, stamp duty value will be ignored. So that for the purpose of computing capital gains, we'll be taking this 1 lakh and not 1,10,000 because it is not exceeding 10%. So if we just go back here and read this further, read it again. So if the stamp duty value does not exceed 110% of the sale consideration, then the sale value consideration shall be sale value for computing the capital gains tax for sale transaction with effect from 1st April 2021. Is that clear to all? Okay, so we'll do this question so you'll understand that, okay? Because this question was, that's why we did it, okay? So just come back to this. So now, from the following details provided by Mr. Singh, the assessee for the financial year Itna, the assessee furnished the following information regarding the sale property at Chennai. Mr. Singh father acquired Mr. Singh's father acquired a residential property in April 2006 for 1,25,000 and thereafter gifted this property to assessee Mr. Singh on 1st April 2007. Okay, so that means in the same financial year, this property was bought by Mr. Singh, okay, and given to Mr. Singh, his son, on 1st March 2007. The property so gifted was sold by Mr. Singh on 10th June 2023. The consideration received was 25 lakhs. Stamp duty charges paid by the purchaser at the time of registration at the rate of 13% as per the statutory guidelines was 3,90,000. So this was the stamp duty which was paid by the purchaser. The person who bought the property from Mr. Singh, he paid a stamp duty of 3 lakhs. The person who buys has to pay the stamp duty. Okay, fine. So compute Mr. Singh's capital gain for the assessment year 2023-24. Okay. Fine. So let's look at this. Okay, here also there's a change actually. This should have been 2024, 25. Okay. So let's look at this. So what was the capital gains? Full value of consideration. Now, how we have arrived? First, what was the actual consideration? 25 lakhs. Look at this. Actual consideration was 25 lakhs. Then stamp duty value, which is, how much stamp duty was paid? 3,90,000. 3,90,000. So if we capitalize it, that means if you, divide this and make it 100%, then the property value should be 30 lakhs. On 30 lakhs, when you pay 13%, it comes to 3,90,000. Okay. Whereas what was the actual purchase consideration? 25 lakhs. So how much is the stamp value higher than the actual consideration? 121%. Okay. So which is 120. This is 120%. So that means the stamp value has to be used for the purpose of calculating the capital gains, not the actual value, because the actual value is the stamp duty value is 120% of the actual consideration. So in that case, we will use the value of the stamp duty. So stamp duty value is greater than 110% of the actual consideration. Okay. So we adopted this. Then acquisition cost, because the property was costing 1,25,000. It was purchased by Mr. Singh's father at 1,25,000. So this was the cost to Mr. Singh's father, and this value would be taken for the purpose of, for his son when he sold the property, and it happened the same year. So which means in 2006-7 when the rate was 122. Okay. So this is 122, 348 divided by 122. So that means the indexation would be this. Okay. So which means the long-term capital gains would be 26,43,243. So this will be the long-term capital gain. So so had we taken this value instead of this, if this law would have not been there, then the tax would have been, the long-term capital gain would have been only 21 lakhs. Assuming that the tax is 20%, long-term capital gain is 20%, so the tax would have been this much. So so let's go back and make it 30, which is the case. So here the government was getting 5,28,000. Okay. So here the tax was 5,28,000. But if this law would not been there, then the tax would have been 4,28,000. Okay. So this is this thing. So is that okay? Any questions here? Have you followed? Kajal, Dia, others?
Yes, sir.
Manu? Manu?
Yes, sir.
Is it
Yes,
clear to
sir.
you?
Yes, sir. It's clear.
Now tell me, Tejasvi, in what circumstances the stamp duty value has to be taken, not the real value, the transaction value? Sanchit? Arvind?
Yes, sir. If stamp value is greater than 110% of the consideration value.
Absolutely, absolutely. So if the stamp duty value is greater than 110%, in that case, the stamp duty has to be taken. Okay.
Yes, sir.
In case if the stamp duty value is less than 110%, then what value will be taken?
So then consideration value will
Then the
take.
consideration value. Absolutely. Yeah, you're right. So I think you have followed. Tejasvi, have you followed now? Manu?
Yes, sir.
Okay. Kishore, is that clear?
It is clear, sir.
Okay. So now, the last question will be doing very important. Okay. So please focus. This is the most important question. Okay. Fine. So, but before we do that, so we must, understand some more law. Now, Kishore, can you read this?
Sure, sir. Tax treatment of advance money forfeited on failure of negotiations for transfer of a capital asset. Section 5156.
Okay, just hold
If
on.
ad-
Just hold on. Sometimes what happens is it is not, it is, it may happen with anyone. Suppose you are trying to sell your property. Okay. So you enter into a deal with someone and he gives you an advance. Okay. But, you give him time that, balance of the consideration price has to be paid within a month's time or 2 months' time or whatever time. And the person does not turn up. So, as per the clause in your agreement, you may say that whatever advance I am receiving, that will be forfeited if you don't pay the balance amount. Okay. So, sometimes what happens is that there is a deal and you collect an advance, and the buyer does not pay the rest of the amount, and that advance will become your money. The person who has sold, he will not going to return. Suppose that is the part of the agreement. Okay. As we know that there is always a term which is called bayana. So whenever you pay the bayana and you don't turn up, then the bayana is forfeited or the advance is forfeited and it belongs to the person who has sold the property. So that is called the advance money. Now, there are two treatments which are there when you receive the advance money. Now, if the advance was received and forfeited before 1st of April 2014, and the second case is advance was received and forfeited on or after 1st April 2014. As per income tax purposes, there are two treatments. If the advance was received before 2014, 1st April, or if the advance was received after 1st April 2014. Now, if it is received before 1st of April 2014, okay, advance forfeited to be deducted while determining the cost of acquisition for computing capital gains. So whatever advance you have received, that will be deducted while calculating the cost of acquisition. Your cost of acquisition of that property will be lower. Okay. So the taxability is postponed to the year of actual transfer of the capital asset. That means whatever advance you received in that year, suppose you received the advance and you forfeited, and then for next 5 years you didn't go for selling the property. So that money is with you and you haven't paid any tax on that. So that means the taxability is getting postponed to the year when you are actually transferring the asset. So since there was an anomaly, so now that was corrected, that if the advance is received and forfeited after first, then the advance forfeited would be taxable as income from other sources in the year of receiving that amount. Okay. So that means it is not going to reduce the cost of acquisition. Is this clear? We'll do a question so that you can understand. Okay. So we will do a question. Okay. So we'll understand that. Okay. So then I'm going to take you again to this place. Okay. Okay. So now we are doing, Kishore, you have to read this exemptions of capital gains. Now, you know, as per your computation, it may happen that you have to pay a tax. Okay. You may have, had a long-term capital gain or a short-term capital gain, but you don't want to pay the capital gain tax, which is 20%. Can you, reduce your taxation? Can you avoid your taxation? Okay. So there are certain exemptions which are given under the capital gains. The first exemption is this. Okay. Read this, which is called Section 54. Okay. Sure.
Capital gains on the sale of residential house. Eligible assessees, individual and HUF. Conditions to be fulfilled: there should be a transfer of residential house, building or lands appurtenant thereto. It must be a long-term capital asset. Income from such house should be chargeable under the head income from house property.
Okay. So this is basically a case where you are selling a residential house. So this section 54 is an exemption given only in case if you are selling a residential house. Okay. Then in case if you have to pay a capital gains, can you avoid it? So who are the people who are eligible for this? Individuals and only HUFs and no other one. Conditions to be fulfilled: there should be a transfer of residential house or land appurtenant to. That means the land which is part of the building. Suppose you have a building and there is a small land which is, there is a park or a parking area or whatever. So there is a land which is part of the building. So that is called the land appurtenant to. Okay. So it should be a long-term capital asset. So that means you have hold the asset for at least 2 years and then you are selling and making a capital gain. But if you are selling a house after 1 year, then it is not a long-term capital gain and this section 54 will not be applied. Okay. Okay, read this.
Where the amount of capital gains exceeds rupees 2 crores. Where the amount of capital gain exceeds 2 crores, one residential house in India should be purchased within 1 year before or 2 years after the date of transfer, or constructed within a period of 3 years after the date of transfer.
Okay, just hold on. So the first case is where the capital gain exceeds 2 crores. Suppose you have bought a house for 1 crore and you have sold for 5 crores. So which means that you are having a capital gains of 4 crores. So this is the first case where you are having a capital gains of more than 2 crores. So where the amount of capital gain exceeds 2 crores, one residential house should be purchased within 1 year. So that means you have to buy another house. If you want to save tax, so you should immediately buy a house. That means within 1 year. Okay, within 1 year. Purchase within 1 year. Before, that means you can even buy it before also. Okay, but it has to happen within 1 year or 2 years after the date of transfer. So you can, after selling your property within 2 years, you can buy another property, a residential property, or constructed within a period of 3 years after the date of transfer. So there are three things: either you purchase the house within 1 year, or you buy the house 2 years after the date of transfer, or you construct a house within a period of 3 years after the date of transfer. So
So,
yeah,
sir, in these three cases, we will get the exemption
we'll get the exemption. Suppose, for
on entire
example,
amount.
to add to it, suppose you are having a capital gain of 2 crores. Okay, so you bought a house within 1 year, or you constructed a house within 3 years, or you purchased the house within, after 2 years, which is
Hmm.
value is of 2 crores. So you bought a new
Okay.
house for 2 crores. Then you don't have to pay any tax. Okay,
Okay. That entire capital gains will be set off here.
absolutely. So, but if you have purchased the house for only 1 crore, then 1 crore you have to pay tax.
Mhm.
Okay. But if you bought the house for 3 crores, you don't have to pay any tax because it is exceeding 2 crores. But you have to buy a house, up to 2 crores at least to avoid tax. Okay. Is that okay?
But this sort of benefits are applicable only in the higher transactions amount. Suppose our capital gains is, let's say, 20 lakhs, and we are buying.
Which is coming the second one. Read the second one.
Okay. Where the amount of capital gain does not exceed rupees 2 crores. Where the amount of capital gains does not exceed rupees 2 crores, the assessee, that is individual or HUF, may at his option purchase two residential houses in India within 1 year before or 2 years after the date of transfer, or construct two residential houses in India within a period of 3 years after the date of transfer.
So you
Okay.
can still buy, maximum you can buy two houses. Even if you buy one house, it's okay. Okay, fine. But here you have given a choice to buy two residential houses. Okay, fine. So, but you can still, even if the consideration is below 2 crores, you can still invest in a house and you get the same benefit what you are getting in the first. But in the second, you're getting an advantage that you can purchase two houses. Okay, fine.
But there is one thing, sir. Like I have sold a house this year. Say my capital gain is 1 crores.
Yeah.
So in this year, that would be considered my income, and that I need to file the ITR, and my tax will be deducted.
So in that case, you know what happens is, because if you are having 1 crore, so you have to suppose you are going to buy, you are going constructing a house, so you can do it within 3 years, isn't it? So how do
Mm-hmm.
you manage your taxes? So in that
Yes.
case, whatever amount you have received by selling your residential house, you have to put in a bank account, and which is called the capital gains account. Okay. And you can't take out any money. You can only take out money for for funding the house. Okay. So there is a, you go to the bank. Okay. And ask that you want to open an account which is called the capital gains tax account, where you can deposit the entire money there, and mention in your income tax return that you have deposited this money in a capital gains saving account, where you're using only for constructing the house. Okay. In that case, you don't have to pay any tax in that year. Okay.
Okay, sir. Okay.
So, if you have suffered, if you have made a capital gains and you plan to buy a house, if you have not bought the house within the same financial year in which you have sold it, so you can park that money in a separate bank account, which is called a capital gain account, and deposit the money there. Okay. And
And
use
then
the
only
money.
we'll be able to
Yeah.
get the tax benefit.
So either purchase a house within 2 years, or construct the house within 3 years. So the
Yeah.
money will be used for from that account. Okay, is that okay?
Okay, sir. Okay. Yes,
Okay,
sir. Got it.
okay, so okay, just read this.
Quantum of exemption. If cost of new residential house or houses greater than long-term capital gains, entire long-term capital gain is exempt.
Okay, so
If
this is the
cost
first
of new
case. Yeah, yeah. That means if the new residential house which you are buying is greater than the long-term capital gains, so don't have to pay any tax. Next.
if cost of new residential house or houses less than long-term capital gains to the extent of cost of new residential house is exempt.
So if suppose your gain was 1 crore and you invested, or your gain was 2 crore and you invested only 1.5 crores, so which means that 50 lakhs, on 50 lakhs you have to pay the tax. Is that okay?
Yes, sir.
Okay. So now let's do a question. So the most important question. Okay, fine. Read this.
Hari has acquired a residential house property in Delhi on 15th April 2002
Okay,
for
just hold on,
9
just
lakh.
hold on, just hold on, just hold on. Let me just see if there's something else to be done. No, we will do that later on. So let's go with the question itself. So I'll explain that, something which is there. Okay, read this.
And decided to sell the same on 3rd May 2005 to Miss Puri, and an advance of 25,000 was taken from her. The balance money was not paid by Miss Puri, and Hari has forfeited the entire advance sum. On 3rd June 2003, he has sold this house to Mr. Suri for rupees 43 lakhs. On 4th April 2023, he had purchased a residential house in Delhi for rupees 8 lakh, where he was staying with his family on rent for the last 5 years and paid the full amount as per the purchase agreement. However, Hari does not possess any legal title till 31st March 2024, as such transfer was not registered with the registration authority. Hari has purchased another old house in Chennai on 14th October 23 from Mr. X, an Indian resident, by paying rupees 5 lakh, and the purchase was registered with the appropriate authority. Determine the taxable capital gain arising from above transaction in the hands of Hari for the assessment year 24-25.
Okay, fine. So, here Hari has purchased a residential house in Delhi on 15th April 2002 for how much? 9 lakhs. So, he decided to sell this the same to on 3rd of May 2000, 5. So, this is before 2014 advance taken. Okay. Now, the date was, if you just remember this, which we did was I'm just opening.
2014.
हाँ 2014 के था. So I will just we'll go. So it is before 2014. Okay, so that means it has to be reduced. So it will not be considered as other income. Okay, now it is considered as other income if it happens after 2014. Okay, so balance money was not paid. So Hari has forfeited this entire sum. On 3rd June 2023, he has sold his house to Mr. Suri for 43 lakhs. Okay. Now, now he has made a capital gain because his house was 9 lakh, okay, and he has sold to 14.3 lakhs. So on 4th April, he has purchased because this was sold on 3rd of June. So he purchased, after a 1 month, a residential house in Delhi for rupees 8 lakhs. So here the capital gain would be definitely below 2 crores. So he can buy 2 properties. So he has purchased one property in Delhi where he was staying with his family on rent for last 5 years and paid the full amount as per the purchase agreement. Now, once you pay the purchase, as per agreement, you pay the full, price. Then the next step would be that you will go for registration, okay, and go to the registrar and get the name of the property in your name. But in this case, Hari does not possess any legal title till 31st of March 2024 because the property was still not registered. Okay. So anyway, the income tax department says that even if it is not registered, you can still get the benefit. Okay. Because sometime the registration may happen after some time. So it doesn't make any difference. Okay. So Hari has purchased another old house in Chennai. So he purchased another old house on 14th October 2023. So this also he purchased, within the time. So within, 2 years. The time given is within 2 years. So he purchased another house from Mr. X, Indian resident, by paying 5 lakhs. Okay. So this was registered. Okay. Now let's go and check the answer. So here, what was, first of all, computation of taxable gain of Mr. Hari for assessment year 2024-25. Okay, fine. So the sale proceeds was 43 lakhs because he sold the house for 43 lakhs. Okay. Then index cost of acquisition is 29 lakhs. How do we arrive at? So cost of indexation was, cost of acquisition was 9 lakhs since he purchased the house for 9 lakhs. Okay, this 9 lakhs. Fine. So he purchased the house on 15th of April 2022. Okay, fine. So that means 2003, the index was 105. He sold in 2023-24 when the index was 348. So, but then he had taken an advance. Okay, so advance will reduce the cost of acquisition. Okay, so since the advance was taken before 2014, so when he sells the property, this advance will be reduced from the cost of acquisition. So the cost of acquisition will become lower, and then he can apply the the indexation benefit. Okay, based on this formula. Sorry. So it is basically 348, 105, okay, the 875 multiplied by 348 divided by 105, so it comes to 29 lakhs. Is that okay? So what we'll do with the advance, we're going to reduce the advance, okay, and calculate his cost of acquisition. It will lower the cost of acquisition, okay, and then at the lower cost of acquisition, the indexation benefit will be applied, and then this will go here, 29 lakhs. So 43 minus 29, so that means his long-term capital gain will be 14 lakhs. Is that okay? Then he has purchased two houses, one for 8 lakhs in Delhi, the second house for 5 lakhs in Chennai. So both he can buy two houses since his capital gain is below 2 crores. So that means the long-term capital gain now will be 1 lakh. Okay. So just read this, Kishore. Or Kajal, can you read?
Yes, sir. Advance received and forfeited on or after 1st April 2014 is taxable under Section 56 2. 9. Such amount would not be reduced to compute index cost of acquisition while determining capital gain on sales of such property.
Hold on,
However,
hold on,
in this
hold on. हाँ चलो आगे पढ़ो पढ़ो.
However, in this case, since the advance was received and forfeited in the year 2000 has to be reduced for calculating index cost of acquisition for the purpose of arriving at capital gains.
Okay, hold on. Now, in this case, we have reduced the advance, from the cost, and calculated the index cost of acquisition based on the reduced cost. Because the law says that if the advance is received on after 2014, then that advance will be shown as an income from other sources. Section 56 basically is, income from other sources. Income from. So this is very important. Now, if you receive an advance and you forfeit the amount, it will be taxable under the head income from other sources. If it is happening now, which is beyond 2014. But if you have received some money before 2014, then when you sell the property, then you can take the benefit of this advance. It will reduce your cost of indexation. Okay, and of course you can't. I mean, because you are passing the taxability in the year of sale basically. Okay, because you received this advance and you didn't pay any tax on that, so you are paying it only later. Because your cost of acquisition will go down and your income tax liability will go up, isn't it? So, like for example, in this case, suppose this advance was received after 2014. In that case, what would have happened was that his total long-term capital gain would have been, let's just check, it has not. Okay, so I think ये ऐसे था. Formula was not. So suppose this, this advance was received, so the tax liability would have been this. Okay. So long-term capital gain, so it's not been properly this thing. Let me just put all the formulas. So in this case, the long-term capital gain, so this has reduced the capital gain of 43 and 43 minus 29. Yeah, is it okay?
Yes, sir.
So if the advance would have been, would have received after, then he would have paid the tax, in the year of actually, when he received the advance. So this would have been considered as his income. So this will not reduce his cost of acquisition. Okay. So the cost will be higher here and his capital gain will also be lower in this case. Okay. So now if we restore this and make it 25,000 here, because this advance was received, so his capital gain is 1 lakh. Okay. So his capital gain has gone up basically because we have taken an advance here. So he is now actually has to pay tax here. Okay. From, let's say, tax is say 20%. So let's say the tax is, so let's say the tax is 20%.
Sir, in which case we won't deduct this 25,000? Had it been
just hold on, just hold on. Let me just complete this. So his tax is 20,000 in this case. Okay, fine. Let me just make it a little bit better, and then I'll answer your question. Now, in this case, this is the case where he has got. Now, if you go to the question, he has received the advance on 3rd May 2005. That is before 2014. Okay. Now, if you look at the we'll just open the file capital gains. I'll just show you the law again, which I closed it. So this is important, and you must look at it. Fine. Oh. So this is the case, tax treatment of advance money forfeited on failure of negotiation. If the advance was received before 1st of April 2014, or if the advance was received after 1st April 2014. If it is before 1st April 2014, then the cost of acquisition needs to be adjusted for computing the capital gains. In case if the advance is received after 2014, then the money which you received as advanced in the year itself, it will be taxable as income from other sources. Is that clear to everyone?
Yes, sir.
So I just repeat again that if you are selling a property, okay, if it happens after 1st April 2014, and if you received some advance and the deal doesn't go through, the advance is forfeited, then you have to pay tax in the year of advance itself. And the tax will be under section 56(2), subclause 9, as income from other sources, which is the fifth head of income. So you have to pay the tax in the year of receiving the advance itself. Okay. But in case if the advance was received before 2014, now the 2014 has already gone by, so it is academic in nature only. So, but if you might have received something, advance before 2014 and selling now, it may even happen, because in this question, you got the advance in 2014, before 2014, and you are selling now. So in that case, you have to reduce the cost of acquisition. Okay. Fine. So that is exactly what we have done. So just here, you have received the advance on 3rd May 2005. How much? 25,000. So if you just go here and look at this, so your cost of acquisition was 9 lakhs. Advance received was 25,000 because it was before 2014. So your cost of acquisition has become 8 lakh 75,000. So which means that your cost of acquisition going down. So that means your tax liability is going up in this year. But in case if it was received, the money would have received now, you would have paid the tax also. So your capital gain tax would have been not now higher. Okay. So let's check that. So suppose you have received this money, after 2014. Then what was your tax liability? Only 3,004 for this year. Have you got it now? Because since you have taken, you have not paid your taxes because it was received, way back in 2005, of which year? Yeah, 2005. Okay. So you included this in this year, and your cost of acquisition has come down now. So your tax liability will be 20,000. Have you got it?
Yes, sir.
So up
So essentially, if we see in present times, if we take any sort of advance, that is a kind of
other
loss
income.
for
That
us,
is the
or
other income. You have to pay the tax itself in the year when you receive that money which you have
that
forfeited.
won't give any added advantage.
That will not. So you are not postponing your tax liability. That means here you are postponing your tax liability. Maybe you received the advance in 2005. You are paying. You are selling the property in 2023. So you have waited so many years to pay your tax now. Okay, fine. So if this was the case, in recent times, then this figure would have been there, and your actually tax would have been only 3,000. Okay, fine. अब समझ में आ गया ये?
Yes, sir.
Is that clear to everyone?
Yes,
Yes,
sir.
sir.
Okay. So now read this. Yeah. Kajal.
In order to avail exemption of capital gains under Section 54, residential house should be purchased within 1 year before or 2 years after the date of transfer, or constructed within a period of 3 years after the date of transfer. In this case, Hari has purchased the residential house in Delhi within 1 year before the date of transfer and paid the full amount as per the purchase agreement. Though he does not possess any legal title till 31st March 2024, since the transfer was not registered with the registration authority, however, for the purpose of claiming exemption under Section 54, holding of legal title is not necessary if the taxpayer pays the full consideration in terms of purchase agreement within the stipulated period. The exemption under Section 54 would be available, as it was so held in Balraj versus CIT
Okay,
and
just hold on.
CIT
Just yeah.
versus Shahzada.
Okay, so this is a decided case. It's a decided case where it says that even if you are not holding your a title because your property is still not registered, so for tax purposes, it doesn't matter. You have to pay taxes. Okay, so maybe Balraj was a person who contested because the property was still not sold because the purchase agreement has not been registered. So he wanted to avoid a tax liability, whereas the court held that no, I mean, you have to pay tax for the purpose of paying taxes. The title is not very important. Since you have purchased the full amount and you have just, delayed that registration of your title deed. So it doesn't mean that you can, delay the tax, I mean, also by that amount. So, I mean, that for purpose, the title is not very important for paying taxes. Okay. Read this last one.
As per Section 54, since the amount of capital gain does not exceed rupees 2 crore, Mr. Hari can claim exemption thereunder
Yeah.
in respect of investment made in two residential houses situated in
So
India.
in this case, what he has done, he has bought two houses. So let's go and recap. This is Mr. Hari, and we are trying to calculate his capital gains liability for the assessment year 2024-25. So he sold the house for 43 lakhs. Okay. Then we calculated his index cost of acquisition because his index cost is coming to 29 lakhs. He purchased the house for 9 lakhs. He got an advance way before 2014. Okay. So his cost of indexation has to be applied at 8,75,000, which is he has sold it now. So the index is 348. When he purchased it was 105. So which means the index cost of indexation would be 29 lakhs. So index cost of acquisition will be 29 lakhs. So that means he has made a capital gains of 14 lakhs, which is 43 lakhs minus 29 lakhs. So this is his capital gains. Now he can avoid this capital gains by purchasing maximum two houses or even one house. So here he has purchased one house for 8 lakhs. Then he buys another house for 5 lakhs. So this is the house which he purchased. Okay, within 1 year. He has purchased before even he sold his first house. So he can always do that. Okay, but only in this question because he was not having title deeds registered in his name, doesn't matter. It will be still considered as a house for the purpose of for claiming the tax benefit. Then exemption under Section 54, he purchased another house in Chennai within 1 year. The time given is within 2 years, so he has purchased in that time frame. So 8 lakhs plus 5, 13. So that means his capital gain is 1 lakh. Okay. So he has to pay say 20% tax, for example. So it will be 20,000. Of course, 4% cess has to be added here. So this will be his liability. Okay. Now there is one more provision. Suppose he wants to save this 1 lakh also. So that means he has to buy a bond. Okay. So there is a bond which is called a capital gains bond, which I'm going to discuss now. Last one before we move on to the income from house property. The last one. So I'm just moving to, okay. So exemptions on long-term capital gain on sale of residential. So this is what we have done. The first one is what we have already understood. The second is investment in bond. The first one, investment in one or two residential houses, as the case may be in India. Exemption under Section 54, purchase within 1 year before or 2 years after the construction, within 3 years after the date of transfer. So capital gains or cost of new house, whichever is lower, is exempt. So either you invest whole of the money, okay, and save your taxes, okay. So capital gains or cost of new house, whichever is lower, is exempt, right? Now, if there is some more liability, for example, Okay, you can save it by putting your money in bonds. So, which is called exemption under section 54 EC. So, you have to invest your money in capital gains bond within 6 months from the date of transfer. Maximum amount you can do is 50 lakhs. So, if you invest 50 lakh rupees maximum, then you can save your taxes. Okay. Now, let me just give you this thing before we go. Okay, just read this, Kishore.
Example, if the long-term capital gains is rupees 2.05 crore and the cost of the new house is rupees 3 crores, then the entire long-term capital gains of rupees 2.05 crore is
Is
exempt.
that okay?
Yes, sir.
Okay, second.
If long-term capital gains is rupees 2.05 crore and cost of new house is rupees 1.55 crore, then long-term capital gains is exempt only up to rupees 1.55 crores. Balance rupees 50 lakhs is taxable at 20%.
Okay. So in this case, because the cost of new house is 1.55. Now he has balance of 50 lakhs. He can even avoid this tax if he invest this 50 lakhs in capital gains bond. Okay. Suppose he invest in capital gains bond 50 lakhs, then he doesn't have to pay any tax. Okay. Fine. So that capital gain bond is like this, which I showed you. So this is bond which is issued by REC. There are many companies which are issuing. So it's called secured non-redeemable capital gains tax exemption bond. So you can buy up to 50 lakh rupees, okay, and save your taxes. But you have to buy it within 6 months. So this is the bond which I bought, Pravesh Agi HUF. But the interest rate is very low, which is 5.75%, and your money is locked for 5 years. So the disadvantage is that you will get your money after 5 years, okay, at a very low rate of interest, but you save your taxes, okay. Suppose in this
So, sir,
case,
this we can save the capital gains by buying this sort of bonds.
yeah. Suppose
Capital gains from yeah.
yeah,
Capital gains from any sale of house, property, and those things.
yeah, any kind of a capital gain, okay, long-term capital gain.
Okay.
Fine. So let's investment in bonds or any. So if you buy a bond, now exemption of long-term capital gain on sale of residential. So it's sale of residential house. Okay. So the other, is that you can buy bonds within 6 months and save your tax. Okay. So remember this also. Fine. So now we are going for a break. Okay. I'm just